Well, hello there and welcome back. I'm Jen and welcome back to Pay Down Debt Solutions. So, for those of you that are new to us, I am going to do something today to kind of peel back the layers of the onion and show you guys, in depth and in detail, how to do velocity banking and how to make velocity banking work for you. Because if you are coming to us new and we appreciate you, I want to show you what Dan and I learned about our finances and how to make a change so that you can free up cash flow and pay your debts and pay them down quickly. So, again, my name is Jen, and those of you that know me, I come to you with a vast knowledge of the banking world and banking products because I was an ex banker and I was an ex branch manager. And so I learned how to use all these products at the bank that none of us seem to know very well. At least none of us seem to know how to use them properly. Let me put it that way. So Dan and I are business owners and we started Pay Down Debt Solutions to help you because we learned velocity banking after years of trying to traditionally bank and failing miserably at it. We have been business owners. So, again, I say ex branch manager and ex banker because for a while I did work in the financial industry and I was in banking and I actually was looking to go into to get my Series 7 and go into investments. I chose not to do that at the end of the day. But we are business owners now. And so Dan and I have gone off and years ago, we went off and we started our own businesses and we ran our own businesses for many years. And while we were successful business owners, we still felt payment poor and we were payment poor. We were strapped by our finances because we did not know how to run banking the way I'm going to teach you how to run banking today. So again, not the fault of the bankers, right? Not their fault because they don't know. Not the fault of the branch managers because they don't know how to run their finances or help you learn to run your finances the correct way. So they're going to sell you a product at the bank, and yes, they do sell them. They're going to sell you a product at the bank, but they don't know how to use them the way I'm going to teach you. So, can you be at even with no cash flow and learn velocity banking and free up cash flow? Yes, you can. Can you be slightly negative and feel payment poor and be strapped and learn velocity banking and free up cash flow? Yes, the answer is yes. But today, what I want to do, again, like I said, is peel back the layers of the onion because what we're finding is that people are confused by payment or by paycheck parking. So they find that whole concept confusing and they find it confusing that we're depositing money onto our lines of credit to help us get out of debt. Okay. So the very thing that you guys think are these evil products, right, that got you into debt can actually get you out. And I'm going to teach you how to love your credit cards. Learn to love them, learn to love lines of credit, but never, ever, ever get a loan. So always a line, never a loan. And I'm about to show you why. Okay. So paycheck parking with velocity banking. So this is one of the key elements of velocity banking, okay? It's a key element because it's about where you're putting your money. Where you're putting your money makes a big difference, and it is the difference between traditionally banking and velocity banking. So I want to help clear this up for you just a little bit and then get into the details on how velocity banking works through two very simple examples, okay? So we'll give you those examples in just a minute and you are going to be amazed. I know you are. And you're going to feel the freedom that Dan and I felt once we learned how to do velocity banking. Again, I tell my story. Dan and I actually approached bankruptcy. We thought we were going to have to file for bankruptcy because we were so payment poor and we didn't know the proper way of using the tools at the bank. And so we almost found ourselves, at the doorstep of bankruptcy. And we actually consulted a lawyer and talked it over, mulled it over. And before we made that decision, I found velocity banking. I have never looked back, and I'm putting you in the driver's seat today so that you will do the same and never look back because you don't need to file for bankruptcy. More than likely, we can help you avoid filing for bankruptcy and getting yourselves out of debt. And even if you're not close to bankruptcy, that's great. And if you have a little bit of cash flow, I'm going to teach you how to get more cash flow to get yourselves out of these debts even faster, because it is possible, and it's more than possible. It is doable, and it is doable really fast, okay? So let's take a look at payment parking and how this looks, right? What this looks like for you when you're entering Velocity Banking. So we're going to go over traditional banking, and we're going to go over banking the Velocity Banking way and show you the difference. And then we're going to apply it with an example, okay? All right, so when you move your paycheck into your line of credit, okay, this is a key element of Velocity Banking, because without this, we cannot do this strategy and Velocity Banking wouldn't exist, okay? But it does exist because we're able to do that with these very special tools that we call lines of credit. Always, always, always a line, never, ever, ever alone. And the reason for that is lines of credit are calculated on an average daily balance. And an average daily balance is what keeps you in the driver's seat with your interest. When you have a loan that is amortized, and by amortization, that is a front-end loaded schedule where all the interest that you're going to pay it up front, close, and sooner than you are at the back end of that loan, which means the banks get their money. So even if you were able to pay off that loan, they're getting their interest rapid fast, right? They're getting it up front so that they can then, that's their way of getting their money for the financing that they're giving you. But I'm going to teach you how to finance your own stuff a little bit faster, right? With less interest paid over time. All right. Okay. So traditional banking. So this is an example of traditional banking, right? So we have your paycheck, right? So in this example, we're using 3,100. We're going to use 3,100 in my examples over here today too. So $3,100 is what this person makes in a month, okay? I don't care how they make it. I don't care if it's by a weekly, bi-weekly, monthly, whatever, daily. I don't care how they get paid. It doesn't matter. But in this example, we're going to use $3,100. They get a paycheck or they get direct deposit, either way, okay? And that paycheck then goes into their checking account, okay? So paycheck goes into the checking account. We've got $3,100 sitting in our checking account here. And then that checking account is responsible for writing checks or doing direct deposits and paying out bills and living expenses, right? So here we have the 3,100. We're paying for our rent, we're paying for our car, we're paying for our utilities, we're paying for other living expenses, we're paying medical, we're paying insurance, we're paying our phone, we're paying our gas, and we're paying for our groceries, all out of our checking account, okay? So money comes into that checking account and then poof, it's gone, because throughout the month, you're purchasing things. You're purchasing things to survive and to live, and you're also paying your loans and your debts out of that as well, okay? So this is your traditional banking experience. Now, if you have anything left over, okay, so if you have anything left over, this money then, right, if you do, is going to go into savings, right? I don't know what's going on with my S's, but they look terrible today. All right, so if this is your savings. That's pretty poor. Sorry, guys. So if you have anything left over, it's going into savings. And in my example, this person is going to start with some cash flow. It's going to be, let's see, $240 is going to be their cash flow, okay? Here's the thing though. We all know that $240 can be gone like that if we have something crop up in the month that takes that money from us, right? So any little expense that happens, any unforeseen expense, I guess I should say, can take that money and wipe it out, and then you're at zero, or maybe you're even negative. And if you're banking traditionally, you go to your savings if you have one, or you go to that credit card. And this is how credit cards creep up on people, okay? So the credit cards start creeping up, right? Because you have these unforeseen expenses. And then what happens is, if you can't, eventually you have so many credit cards going on that you go out and you say, okay, bank, can you please give me a loan? Never a loan, right? In my book. But you go out and you ask for a loan, and those bankers are going to sell you a loan, right? Because, and yes, they do sell, they're going to sell you that loan because they say, great idea, lower interest rate. You don't want to do a line of credit. That interest rate's too high. So we'll get you a loan. We'll set it out there for about 5 years, and then you can consolidate all those credit card bills, and boom, you'll pay it right off, no problem. So while that does alleviate some cash flow for you, the problem is it doesn't do it enough, right? It doesn't alleviate enough. And then you're on an amortized schedule. So had you taken that line instead, which I'm going to teach you today, you would have been in a different position if you knew and you will now know how to velocity bank the pay down way. All right. So traditional banking, you're doing that right now. You're putting all your money in your checking account and you're paying your bills out of it, right? Now, enter in velocity banking, okay? And in this example, this is my credit card example. So let me put that here. So this is our credit card. All right. Credit card example right here. So now with velocity banking, we get a paycheck or we get a direct deposit. Where does it go? Poof, right into that checking account. It goes into that checking account. And then when you bank this way with a credit card, okay, your credit card is going to be your debt destroyer. So your paycheck comes into the checking account. You park it there for a second. And then you transfer it all over into your credit card. So basically you make a payment of the dollar amount of your direct deposit onto your credit card. Minus, though, you have to subtract any charge out there that is non-chargeable. So a non-chargeable expense, and this is my example here, is going to be rent. So if this person had a rent of $980 a month, they have to hold that out of that deposit to their credit card, or that payment to their credit card, I should say, and leave it in their checking account. Okay, so it's left in their checking account. And then their car payment. Typically, car payments cannot be paid through a credit card. So you have to leave out the car payment as well and pay that through the checking account. Okay, so those two charges that add up to $1,300 are held out into the checking account so that you can pay that bill or those two bills out of it. Everything else is chargeable. So everything else goes on that credit card. So that means your groceries, your gas, your insurance, your gym, your phone, your utilities, your nails, your hair, whatever, right? All the rest is going to come out of this credit card. And in this example, it's $1,800. So $1,800 is put on this credit card, right? Is put towards this credit card, or deposited towards the credit card, or made a payment on the credit card of $1,800, holding out the $1,300 to pay your rent and your car. So that is the velocity banking beginnings with a credit card as our debt destroyer, okay? Now, third example here is a line of credit aside from the credit card. So this would be a line, okay? So a line of credit. Now, a line of credit can be a credit card. However, we've already used that example. So that one's a little bit different, and the credit card's a little bit different, and I'm about to show you why. So the lines of credit then in this case are going to be your personal line of credit, your PLOC, your business line of credit, your BLOC if you have one, a home equity line of credit if one is available to you, or a first lien home equity line of credit if one is available to you, okay? And so now we're going to use our example in a line of credit. So what people get confused is how to use the credit card versus how to use the line of credit with their checking account when they do velocity banking. So this is what I'm hoping to clear for you, okay? So here's our velocity banking line of credit style, right? So we've got our $3,100 paycheck, okay? Paycheck or direct deposit sitting over there. Then you get paid, it goes into your checking account. So the $3,100 goes into your checking account, and then you make a full payment to that line of credit for $3,100, okay? So that line of credit then gets a payment made to it of $3,100. So that checking account now is sitting at zero, okay? It's sitting at zero. So now what happens is the line of credit is picking up any payments as they come in, okay? So as your payments come into your checking account, right? Because the checking account is how you've had everything set up, is to pay out of your checking account. So if it's paid up out of your checking account, your line of credit now has a payment of your direct deposit. And so what's going to happen is as these bills and expenses hit your checking account, your money is going to sweep from the line of credit back into your checking account to pay those bills. So as those bills hit your credit or your checking account, they're paid and they're coming out of the line of credit, okay? So when you have a line of credit set up this way, you can do it. There's one of two ways that you usually are available to you, okay? So the first one is exactly what I'm describing. It's a line of credit that is hooked up as overdraft protection. So as those bills hit your checking account, which is sitting at zero, okay, it's actually sitting at zero, that money or those debits that hit that card are going to sweep money from your line of credit back into the checking account. So it just sweeps the money as needed, right? Sweeps it, pays it, sweeps it, checking account pays it, sweeps it, checking account pays it. So that is how it works, okay? So when the rent hits, gas hits, groceries hit, utilities, medical, internet, subscriptions, when all of that hits, it gets paid and it's just sweeping from that line of credit. Very simple, okay? Now, if your bank doesn't offer you a line of credit that has an overdraft sweep like this, you would have to manually move the money. Not a big deal, right? Because you kind of know when those expenses are going to happen. So what you'll do is you just move your money online from your line of credit right into your checking account and you pay your bills, okay? Or you go grocery shopping or whatever you need to do. So you might then, maybe you know that in that week you're going to spend maybe $800 in bills and groceries and gas, right? So then you move over 800 bucks. If next week you need to move over another 500 bucks because you have a couple more bills coming out plus gas and groceries, then you're going to sweep it and move it. And you can do it right from your phone, right? So that's what's so great about being in a cashless society, is the fact that everything is at our fingertips. Now, there are some evils that go along with that. And I know a lot of you out there know exactly what I'm talking about. We'll leave that off to the side, right? But the fact that we have a cashless society, right, makes things very simple, makes it at our fingertips and very easy to move money. And so that is how you would run this, okay? So do you see the difference? The line of credit can pay for everything through it because it's going to that checking account and then being paid through the checking account. So you don't have to hold anything, and there is nothing at that point that is non-chargeable, right? Because it's all sweeping back into the checking account to pay those bills. Whereas the credit card example here of Velocity Banking, you do have to hold out your non-chargeable expenses. So those non-chargeables get held out and then they're paid through the checking account, and all else then you use your credit card to pay for, right? Now, lovely things about the credit card, and I still, to this day, even though I have lines of credit in place, I still use a credit card to pay for all my expenses, okay, except my non-chargeables. Because, why do you think? I know you guys out there know why. Because credit cards can combat interest. They can combat interest because usually they're rewards cards, right? So as you're using them, you're building up rewards. And those rewards then can be turned into statement credits for one, or maybe there's things you want to purchase and you're going to purchase them anyway. So you may as well use your points to purchase them. So that does help combat interest. So I absolutely love credit cards because of that reason. Makes life really simple, and I love simple, right? Simple is easy, simple is great. I hate complicated, I love simple, all right? So now, while all of this sounds complicated, right? It sounds maybe more complicated than it does when you do your traditional banking. It really isn't, guys. Honestly, when you set this up and when you set up your Velocity Banking schedule through your debt destroyer, you are going to find that the most work you see is that first time figuring it out. After that, it runs itself. It's so super simple. You're going to love it. And you're going to love it because it alleviates cash flow for you, okay? So, and how does that happen, right? So that's the big thing here. How does Velocity Banking work step by step? And that is what I want to show you today. So number one is the paycheck parking, okay? So we have to park our paycheck into that debt destroyer, which is our credit card or line of credit, okay? So number one, we paycheck park. Check, we've done that, paycheck park, okay? Then number two is you pick your strategy, right? So you pick your strategy using your debt destroyer. So once you take a look at your finances, once you've organized, identified, and implemented, right? So organized first, now it's time to identify. It's time to identify which plan you're going to use. Are you going to use the maxed card strategy? Are you going to use a split card strategy for credit cards? Are you going to use your home equity line of credit as part of your strategy? Or maybe you're going to use a first lien, but you're going to be picking your strategy here, okay? And then that debt destroyer, and then you're going to release cash flow from your payments because you're restructuring those payments so that you alleviate cash flow, okay? And it's about to make sense in a second. So then, you're going to move all your expenses into your debt destroyer. So the expenses that you can put onto that debt destroyer, you're going to, okay? So again, that goes back to your strategy, whether it's the max card strategy using one card, max card strategy using two cards in a split scenario, or maybe you're consolidating all of your loans and other lines like your credit cards into a personal line of credit or home equity line of credit, and you're hammering away that way. And then those payments all come back to you as cash flow, okay? So that's the beauty of velocity banking, the cash flow that it alleviates for you. All right, and obviously 5 is work down using the new cash flow that you've created for yourself. All right, so, but the pay down strategy is 3 steps, very simple, okay? Very, very simple, only 3 steps. Number 1 is to organize your debts out there. Number 2 is to identify your debt weapon or your debt destroyer, and also the plan of attack, right? The plan you're going to use. And then obviously the 3rd step is going to be implementing that plan, okay? So it's implementing that and keeping yourself on track and on your budget, right? Now, we all know, like I said, this 240 can be blown away in a second, you guys, with just one unforeseen charge of some sort that happens. And that happens almost every month to a lot of people, okay? So there's many people who have cash flow and they're actually operating at even or a little bit behind from month to month because of the unforeseens. And when you're using a line of credit and you're alleviating your cash flow for yourself, you're giving yourself cash flow and you're alleviating those payments, I should have said, that is where we generate more cash flow to help work these down and helps to combat those unforeseens, okay? So that is what is beautiful, absolutely beautiful about velocity banking, and I'm so glad I found it. All right, so here is our step-by-step breakdown. We are going to use our example here of a Bank of America card as our debt destroyer, and then the other one is going to be using a personal line of credit. I don't care how you use it. I don't care what you do, whether it's a credit card or a personal line of credit, but I do want to show you the difference between the two and why the personal line of credit or home equity line of credit or first lien line of credit is actually, at the end of the day, the better way to go, okay? But we're going to show you that in just a second here. Now, I said before that our income was $3,100. That's how much this individual makes, okay? $3,100. Their total expenses are $2,860, okay? So $2,860 as their total expenses. We do have some cash flow in this example. Our cash flow is $240, okay? So we're positive. That's a good thing. The bad thing is we know unforeseens can take that down, right? So that can happen. Now, in this scenario, we're going to start with our Bank of America as our debt destroyer. So what we do then is we have rent for $980. We have a car payment then for $320 a month. We also have our Bank of America credit card, and that we have a balance. Oops, forgot my dollar sign. Sorry, guys. All right, $1,600, our car payment. Okay, so $16,000 is the balance on this Bank of America card. And so that payment is $324 a month. Okay, so that's a pretty steep payment because you're paying back $16,000, right? It's a lot. And this is at 21%. Now, if we allow this traditional banking setup that they started with to carry out, this credit card here, okay, it's going to take them 10 years to pay it back, and it's going to cost them $22,635 in interest alone. That is not including the 16 of the card. That is what makes me sick about the way that we bank traditionally. We just don't know how to do this properly, and that's what I'm teaching you guys, okay? So $22,635 interest on it for 10 years for this $16,000, all right? So our available income, because we're using a credit card, right? Our available income is $1,800. Now, where am I getting $1,800? Here's where. I'm going to get my handy dandy calculator, and we are going to then calculate this for you. Now, our income is $3,100. We need to know what our available income is then, okay? So if $3,100, okay, is what we start with, we have to subtract out our rent and our car from that available income that's going to go on the card, right? Because again, it has to be held into our checking account. It has to be held back. So we take $3,100, we subtract $980, and we subtract $320, okay, which gives us $1,800, okay, as our available cash to use, all right? So that is our available income. Now, we also have to figure out then what our chargeable expenses are, right? Because we already know we can't use rent, we can't use car, and typically you can't pay your credit cards through another credit card. You typically cannot do that, okay, monthly. And so because of that, you would have to hold out this payment as well from your total expenses, okay? So, and we actually hold it back in this case because when we bank this way and when we put our entire income onto our credit card, this credit card to be exact, okay, that payment now is satisfied. So it is gone. The only thing we're dealing with out of that payment is the interest of that card. So this payment comes back to us, okay? So it comes back, it comes out of the expenses. We don't have to then worry about that, okay? So what we're going to do is we take our total expenses, our $2,860, we subtract our rent and we subtract our car, okay, minus $980, and then we're subtracting our, whoops, all right, so we take our, sorry, $2,860. We're subtracting our $980, and we're subtracting our $320, and then we're subtracting out our $324, which gives us this number here, which gives us $1,236, okay? And again, I'm subtracting this payment out because the payment is satisfied with the income deposit that is well above and beyond our payment, okay? So that comes back to us. So now our expenses are $1,236. Our income that's available to use is $1,800, okay? And so we are going to then work down our strategy, all right? So here's what we do. Now, we take our 16,200, we subtract out our income. We are left with 14,400, okay? Then we have to put our expenses back on the card because remember, we're charging up the expenses throughout the month. And we also know that we have to pay interest, okay? So how do we calculate that interest? This is how. We know the credit card is at a 21% interest rate. So what I'm going to do to get a 1 month of interest, I'm going to take the 16,200 plus the 14,400. I'm taking my high balance for the month plus my low balance for the month. I'm adding them together. Then I'm going to divide by 2. That number is then multiplied by 0.21, okay, 0.21. And then it gives me another number that is the year's worth of interest is what that's going to give me, a year at that amount, at that average. So I'm going to divide that then by 12 because I only need 1 month of that. So I'm dividing that by 12 to get me the 267. Now, again, I said that credit cards and lines of credit are all calculated on an average daily balance, which is simple interest. Simple interest then is what makes this work well for us because as our balances come down, right, so does the interest. So you take your high, you take your low, and you're going to average those, which means that you pay less when you velocity bank because you're giving yourself more cash flow to work this down much faster, all right? So you're never really going to pay that 21% at the end of the day, all right? So I continue to work this. This is my month 1. This is my month 2, month 3, so on and so forth, okay? So I'm going to then continue to work this down, all right? So I have my 14,400 after my income comes out. I add in my expenses, I add in my interest, and then I'm left with 15,903. Okay, so 15,903. So I started low and then it has to come back up, right? Because my charges are coming back up throughout the month. And then my income hits again, right? My income hits again through this strategy here, right? Hits the checking account, we pay our rent and our car, and then all the rest goes back on that card. And then we have to put expenses back in. We have to put the interest back in. You remember the high and the low together, the high, the low, add them together, divide by 2, multiply by 0.21, and then divide by 12 to get our interest. And as you can see, it's dropping. So everything in green here is my interest. Everything in blue here is my expenses, all right? And so we continue to work that down, all right? So that is the way you would do velocity banking using a credit card as your debt destroyer. Now, let's say I want to use a line of credit, okay? And I go out, I apply for a line of credit. And why would we want to choose a line of credit over a credit card? Well, the lines of credit typically have less interest, okay? Credit cards are higher in interest. Lines of credit are typically lower. And so we always want to try to go for the lowest interest rate possible because that just makes sense at the end of the day, right? So now we're going to do this using an applied for personal line of credit. So this person applies for a personal line of credit, they get it. Let's say it's $20,000, okay? And it's at a 12% interest rate. So here's what happens. We now are able to use our entire income, remember? We're using our entire income because as the income hits the credit card, we then make a payment to that line of credit. And then as the charges come out, it's swept back into the checking to pay them right out of the checking, which means we don't have to hold out our rent, nor do we have to hold out our car payment or any other credit card payments. They're all going to be paid through the line. Now, the sweep happens automatically, but if you have to do it manually, then you just move it and you pay it all through your checking, okay? So that means our expenses are our direct deposit is $3,100. We can put all of that into the card, but that makes our total expenses $2,536. Now, how did I get $2,536 when we start with this number here, the $2,860? Well, that's because, again, this payment is gone, right? So that payment is the only thing that has to come out of our total expenses. So that comes out and we're left with $2,536 as our expenses, right, for that month. And the interest calculated the same way. We take our high, we take our low, we add them together, we divide by 2 to get our average. Then we're going to multiply this time by 0.12, right? Because 0.12 is 12% times by 100. That gives us our decimal, and we need the decimal. And then we take that number and divide it by 12 to get 146, okay? So as you can see, the interest rate is already half of what it was over here, right? I mean, makes sense. So it's half of what it was there. Now, we're going to then run the scenario the exactly same way. We're going to, run our strategy, not scenario. We're going to run our strategy the exact same way. Every month we're putting in our paycheck and it's dropping our balance, and then our expenses and our interest come out. Now, again, I have to make sure I warn you guys though, because I forgot to mention it. Over here, if you're using a credit card and that's a maxed card and it's high at its limit, I need you guys to micro pay. I need you to put your paycheck on that credit card. You have to divide it up into at least 15 payments, right? There's 30 days in a month, so 15 payments back to that card of a minor dollar amount, right? Because if you throw a big chunk at that card, the credit card companies can lower your limit. And if they do that to you, you're dead in the water, right? Because you then can't put your expenses through that card because they've just lowered the limit on you. So be careful with that. And if you see that when you do your payments every other day, you can then see how the card reacts, and then you can do a little bit more. And maybe instead of every other day, every 3 days, then every 4 days, then every 5 days, then twice a month, right? So just be careful with that, okay? And it may not be a problem at all. It just really depends on your situation, how maxed you are. If you're maxed with every card or just this one card, if it's just the one card, you might be fine. But you just have to be careful with that. So I want to make sure I mention that. All right, so doing the velocity banking strategy. Remember, we're going to reveal this in just a second, but remember, her regular way of paying through the traditional checking account and savings account, remember, it cost her or he or she or whomever, $22,000, okay, $22,635 to be exact, to let it run for those 10 years and pay it back that way. So she or he is paying a ton of money to then borrow the bank's money, right? Now, if we do it through velocity banking, here's what happens. All right. So now, using the Bank of America credit card, right, which is a viable way of doing it and it works really well, right? It takes 36 months, so it takes 3 years to pay all of this, the debt here for the Bank of America card, okay? So 36 months or 3 years, and she or he has paid back $5,594. Oh my gosh, right? That is a huge savings compared to the, where am I? Right here, $22,635. It's enormous, right? This is why we do this, guys, because this is powerful. This kind of savings can make or break somebody's future, just like that, right? So fast. Now, if we use a line of credit, and this is why I'm always saying for going for those lines of credit aside from the credit cards, because their interest is lower and you can then run everything through that line of credit. Doing it through the line of credit, it takes 28 months or 2.25 years, right? And they've paid back a total of $2,364. They've paid out in interest instead of $22,000. Now, that is power. Knowledge is power. You guys remember, you are in the driver's seat. You are the ones that have learned now a different way of banking, a different way of doing things. It is up to you then to make those changes, right? I give you guys choices. It is up to you to make those changes, and those changes can definitely change your life. It sure as heck changed my life. It changed Dan's life. Together, we have, gone on to do amazing things. We are now running this channel to teach all of you. We have a platform that's about ready to pop here that will make this even more simple for you. Thank you guys so much for paying attention today. I appreciate you. All of your comments are amazing, and thank you so much. I do appreciate it. I know Dan appreciates it. And if you like what you see, please give us a like and please subscribe, because the more we can get this out to people, the better off we're all going to be at the end of the day. Have a great day, guys. See you next time.